By early 2026, the technology sector's financial reports began displaying figures that traditional growth modeling can no longer account for. Meta provided capital expenditure guidance for a single year that could reach as high as $135 billion. Broadcom reported $8.4 billion in AI-specific revenue in a single three-month period. And Palantir's Rule of 40 score hit 127, making legacy valuation models for individual companies less accurate. The foundation layer provides the financial bedrock for the entire sector, specifically through Meta's 2026 capital guidance. This chart shows the scale of Meta's 2026 guidance, projecting an outlay of up to $135 billion relative to previous years. This capital is being deployed to build the Llama 4 ecosystem and produce custom MTIA silicon, reducing reliance on external hardware providers. A capital burn of this size generally triggers skepticism regarding shareholder value. However, in 2025, Meta reported a net income of $60.46 billion. That income is generated by an advertising machine that uses AI to match products to over 3.5 billion daily active users. They are also monetizing WhatsApp through automated AI business agents, opening a multi-billion-dollar non-advertising revenue stream. The company is also moving into hardware endpoints to lock in this user base. The Ray-Ban Meta smart glasses serve as the multimodal interface for their AI, capturing real-time user data that rivals cannot access. By reinvesting $115 billion of ad revenue back into their own infrastructure, Meta creates a moat that is difficult for competitors like Apple or Google to replicate. Meta acts as the primary pump for the stack, converting consumer attention into the infrastructural demand that feeds the rest of the supply chain. As capital leaves the foundation layer, it enters the infrastructure layer as revenue for hardware designers. Broadcom's first quarter results for 2026 demonstrate the efficiency of this capital transfer. Under CEO Hock Tan, the company pivoted toward the custom AI accelerators and high-speed networking required to build massive data centers. Total quarterly revenue grew 29% to $19.3 billion. Within that total, AI-specific revenue accelerated by 106% to reach $8.4 billion. This growth is driven by the bespoke nature of these chips, which are tailored to the specific requirements of the major cloud platforms. This same surge in demand has lifted forecasts for memory providers like Micron, creating pricing power across the infrastructure layer. While the revenue growth is notable, the profitability of the hardware segment is the more significant signal. This chart shows Broadcom's $19.3 billion in total revenue, against $13.1 billion in adjusted EBITDA, a margin of 68%. Hardware manufacturing typically operates at margins between 20 and 30%. A 68% margin represents a departure from the historical industry standard. Broadcom is effectively collecting rent on the physical pipes of the AI economy. The infrastructure layer has become a highly profitable gatekeeper, directly capturing a significant portion of foundation-level expenditure. The final stage of the stack is the application layer, where companies use this infrastructure to deploy enterprise software. This relies on commodity cognition, the fact that massive foundational models have made high-level inference cheap and accessible for developers. Palantir has utilized this dynamic to scale its enterprise solutions at a rate that deviates from traditional SaaS economics. Enterprise software usually involves a choice between high-burn growth or slow-scale profitability. In the fourth quarter of 2025, Palantir's U.S. commercial revenue grew by 137%. This scatterplot maps the average software company's operating margin and growth. Palantir's position is well outside the normal cluster. Combining 70% revenue growth with a 57% operating margin yields a Rule of 40 score of 127%. A score of 127% indicates that Palantir is growing at hyperspeed while generating significant cash flow simultaneously. This is achieved through operational leverage. The software uses AI to automate tasks that previously required human headcount, decoupling growth from expenses. The application layer is converting raw compute power into organizational efficiency, yielding metrics that were previously considered unattainable in the sector. Viewed together, the AI tech stack functions as an integrated financial architecture. Platform companies deploy over $100 billion to build foundational ecosystems. This capital flows into silicon designers, who capture it at margins exceeding 60%. This infrastructure then powers application builders, who achieve Rule of 40 scores that break the trade-offs of traditional software. These are not isolated data points. They are the components of a single, continuous pipeline of capital. Attempting to value these companies through legacy lenses results in missing the connection between these layers. The AI revolution of 2026 is a structural reality, an integrated capital pipeline that converts technological scale into measurable operational leverage.